Welcome to the Deep Dive. We're diving into the energy sector today, and it really feels like an industry living in two different worlds at once. You know, on one side, you've got these massive multi-billion-dollar bets being placed on oil that won't even start flowing until, 2029? That's real long-term vision.
Or maybe optimism, depending on your view. But yes.
But then turn around, and those same companies are just obsessively focused on efficiency, cutting capital, squeezing every last drop of performance out of existing assets.
Even using things like machine learning just to stop a single pipe from failing.
It's a real paradox.
It is. And that's really our mission today, to break down these, complementary forces. You've got the big picture, the volatile macro trends, think deep water, geopolitics, even policy wins like in Nigeria. And then we need to connect those dots to the micro solutions, the technology, the consulting, the data management that companies are using to actually navigate all this uncertainty day to day.
Right, like how do you manage that 7-year investment cycle alongside an immediate need for cost cutting?
Exactly. And we'll touch on how specialized firms like EAG Inc., for instance, fit into that picture, providing that sort of operation backbone.
Okay, so our sources cover that whole range, from the big strategic plays down to the nuts and bolts of operational support.
That's the plan. So you, the listener, get a sense of how the industry is juggling both, extreme risk and strategic growth at the same time.
All right, let's jump in. Starting with the big money, the high-stakes upstream investments. I mean, despite all the talk about transition, big oil players are definitely still betting on hydrocarbons.
They are. Take BP, for example. They've just greenlit the Tiber-Guadalupe Deepwater Project, U.S. Gulf of Mexico.
And that's a serious investment, right?
Oh, absolutely. We're talking $5 billion.
Yeah.
And like you said, first oil isn't expected until 2029. It's aiming for around 80,000 barrels a day eventually.
So that signals some serious confidence in long-term oil demand out towards the end of this decade.
It absolutely does. They wouldn't make that kind of 7-year commitment otherwise.
But, committing capital that far out, isn't that incredibly risky given how much the market can swing, week to week?
It would seem so, but there's a key factor here. The project economics in Gulf of Mexico deepwater are actually pretty robust.
How so?
Well, the data suggests these projects remain competitive even if prices fall quite a bit. We're seeing estimated break-evens down in the $35 to $45 per barrel range.
Okay, that's surprisingly low. Competitive with good onshore plays, then.
Very much so. That low break-even provides a significant cushion against price volatility. It de-risks that long-term bet, relatively speaking.
And a project that size, it must send immediate ripples to the supply chain.
Oh, huge ripples, instantly. When a project like Tiber-Guadalupe gets sanctioned, you see demand jump for all the complex kit involved. Subsea equipment, those massive floating production units, the FPSOs.
Right, the floating production storage and offloading vessels.
Exactly. And of course, the rig contractors needed for the drilling campaigns, it really sets the tone for multiple service sectors all at once.
Okay, let's shift continents. Policy seems to be driving growth in some places too, Africa specifically. Nigeria has seen an uptick in crude output.
Yeah, that's a really interesting data point. Their production has climbed back up to somewhere between 1.7 and maybe 1.83 million barrels per day.
And why is that significant?
Because it reverses a long trend of underinvestment and, frankly, stagnation. And it's not just luck. It seems to be a direct result of policy reforms.
The Petroleum Industry Act, the PIA.
That's the one. It seems to be finally doing its job, improving the fiscal terms, clarifying regulations, and actually attracting capital back into the Nigerian upstream sector.
So a direct link between stable policy and investment returning.
It appears so. Of course, you still have challenges on the ground. Operational risks remain, security issues, infrastructure bottlenecks. It's not a simple fix, but the trend is positive for supply.
So we've got these big long-term projects and policy-driven growth.
Yeah.
But you mentioned volatility earlier. Analysts seem worried about the pricing environment, calling it a triple whammy.
That's right. If you're managing risk or capital in this sector, there are sort of 3 main drivers of uncertainty right now. First, OPEC plus supply decisions.
Always a factor.
Always. They've shown discipline, but there's that lingering risk that if they increase output too quickly, you could end up with an oversupplied market, maybe later this year, Q4 perhaps.
Okay, what's number 2?
China. Their buying patterns for crude, how much they import, how much it goes into storage versus actual use. It's just very volatile and hard to read, makes forecasting real demand tricky.
And the third whammy?
Just ongoing geopolitical tension, whether it's the Middle East, Russia, Ukraine, trade disputes, whatever the flashpoint is, It keeps the potential for sudden, unpredictable price spikes very much alive.
That kind of constant pressure, that uncertainty,
Mm-hmm.
it must directly influence how companies plan and spend, right?
Oh, absolutely. When the macro picture is that cloudy, your only real defense is being incredibly disciplined at the micro level, meaning sophisticated hedging strategies become critical. Demanding flexibility in your project economics, maybe phased development, shorter cycle options, and just relentless capital discipline everywhere else in the business. There's simply no room for fat.
Which brings us neatly to that other side of the coin we talked about,
Hmm.
the efficiency mandate. So BP is spending $5 billion, but then you see TotalEnergies cutting upstream CapEx by about $1 billion a year.
That contrast really captures the moment, doesn't it?
It does.
Total's move highlights just how hard growth capital has to work now. Operators are being forced to be, well, ruthlessly selective.
Guided purely by margins.
Pretty much. Every potential project is being scrutinized based on immediate margins and how quickly it can deliver returns. If it doesn't meet those high hurdles, it's likely getting pushed back or cut altogether.
And we're seeing capital deployed for efficiency gains in really tangible ways, especially domestically, thinking about electrification in places like the Permian Basin.
Yes, that's a fundamental shift underway. Vistra Energy, for instance, just announced almost $1 billion for new natural gas power plants right there in the Permian, about 860 megawatts total.
And that's not just about, say, ESG goals or lowering emissions.
It helps with that, sure.
Yeah.
But the primary driver is operational efficiency and reliability. The goal is to replace expensive, maintenance-heavy diesel generators that currently power a lot of field operations.
So moving away from trucking in diesel constantly.
Exactly. Gas-fired power, especially at that scale, provides much more stable, lower-cost electricity. And that stable power is the key enabler for more digital monitoring, for automation.
So it unlocks other tech efficiencies too.
Precisely. And it actually creates a sort of new integrated value chain. Power generation isn't just some external cost anymore. It becomes part of the managed system linked directly to production. You get these new synergies between the upstream guys, the midstream operators handling the gas, and the power providers like Vistra.
That push for tech-driven efficiency, it goes right down to the details, doesn't it? We even found an academic study using advanced data techniques to predict flow line failures.
Yeah, that was fascinating. Using GIS, geographic information systems, combined with machine learning to analyze the risk for flow lines.
And flow lines are the smaller pipes, right? Wellhead to facility.
That's right. Crucial links, but often older and prone to things like corrosion. A failure there means spills, immediate production shutdowns, big cleanup costs.
Stuff you really want to avoid.
Definitely. So what the study showed is that you can use predictive analytics looking at historical failures, terrain data from GIS, maybe even satellite imagery, to identify high-risk zones before they fail.
So moving from reactive repairs to proactive maintenance.
Exactly. The machine learning model flags potential trouble spots, allowing for targeted inspections and preventative work. It's about maximizing uptime and minimizing those potentially catastrophic failure costs. That's efficiency in action driven by data.
Okay, so putting it all together, you've got these enormous deepwater bets set against this backdrop of global volatility and price risk. And that, in turn, forces this intense focus on micro-efficiency, using electrification, using machine learning. How does an organization, especially one that might be cutting budgets like TotalEnergies, actually manage all that complexity?
Yeah.
The tech integrations, the regulations.
Yeah, that's the challenge, isn't it? It's really difficult for operators, especially leaner ones, to build and maintain in-house expertise across all these rapidly evolving areas simultaneously. You need experts in ML, but also experts in your legacy accounting systems and experts in things like environmental compliance or land management.
It's too much for one internal team.
Often, yes. Which is where specialized service providers really become crucial. They bridge that gap.
And this is where firms like EAG Inc. come in,
Yeah.
operating across different parts of the energy sector.
Right. They work with mining companies, upstream oil and gas, midstream, even renewables. Their whole focus seems to be tackling that complexity issue.
What's their core mission then?
Looks like two main things. First, automating and optimizing processes that are currently very manual or repetitive, think data entry, reconciliations, reporting. Second, making sure the underlying data itself is reliable and that the IT systems, the infrastructure holding it all, are optimized.
Because if your systems don't talk to each other.
Exactly. If your new predictive maintenance tool can't pull data from your old asset management system, then the whole efficiency game disappears. It grinds to a halt.
Okay, so looking at their services, They offer standard consulting, which makes sense, but then they have back office outsourcing. Why is outsourcing the back office function so important right now?
I think it comes down to complexity and risk again. Think about things like joint venture accounting, royalty payments, division order processing. These are highly complex, often regulated areas.
Where mistakes can be very costly.
Extremely costly and subject to audits. Outsourcing gives companies immediate access to specialized subject matter experts who live and breathe this stuff, ensuring accuracy and meeting deadlines, often without the overhead of hiring those niche skills internally.
Makes sense. They also mention IT outsourcing and something called New Era Solutions. What's that about?
That new era category seems specifically designed for that do more with less pressure we talked about. It's likely focused on implementing specific technologies or process improvements that deliver significant cost savings or accuracy gains quickly.
How do they pull that off?
Probably by leveraging deep industry-specific knowledge and pre-built solutions or accelerators for common problems, things that are maybe too niche for a generalist IT team to handle efficiently. For example, they mentioned specializing in complex ERP implementations.
ERP like SAP or Oracle?
Could be, or industry-specific ones. They have a long track record, apparently over 20 years, completing, over 100 projects a year, and they claim an 80% client rehire rate.
That rehire rate is telling, suggests they're solving real persistent problems.
It does. It suggests clients see tangible value and come back when the next challenge arises.
Can you give a concrete example of their work, something specific?
Sure. One case mentioned was accelerating a Quorum TIPS implementation for a midstream company.
Quorum TPS. That's specialized software for.
Yeah, for managing the commercial side of pipelines, transportation, invoicing, the complex accounting involved. Accelerating that kind of implementation means the clients start seeing the financial and operational benefits much sooner than they would have otherwise. It shows they're not just advising, they're deep in the technical execution.
And you can see how deep when you look at the specific industry events they're involved with. It's not just high-level strategy conferences.
Not at all. They're tracking updates at things like the Inertia User Conference, that's specific accounting and land management software. They're also engaged with NetOA and NULTA conferences.
Okay, NetOA. It's that National Association of Division Order Analysts, right?
Yeah.
Dealing with payment structures.
Exactly. Super complex, legally binding stuff about who owns what percentage of production and who gets paid. Accuracy is paramount.
And NULTA.
National Association of Lease and Title Analysts. Again, highly specialized work focused on the legal and administrative details of land rights, leases, titles, the foundation of the asset itself.
So, their involvement there shows that the complexity isn't just about new tech like ML. It's also about deeply understanding and managing these intricate, traditional regulatory and legal frameworks.
Precisely. And crucially, integrating the data from both worlds, the physical asset data and the legal commercial data. That's where true operational excellence lies.
Okay, so let's try and wrap this up. If we synthesize this whole deep dive, the energy industry is performing this incredible balancing act.
Definitely.
You've got the long-term optimism, these huge deepwater projects, growth spurred by policy changes.
Right, betting on future demand.
But happening at the exact same time as this intense, almost near-term obsession with capital discipline. Hedging risk, cutting costs, driving efficiency through tech.
It's a tightrope walk, no question. And I think the key takeaway really for anyone working in or around the sector is that operational excellence isn't just a nice to have anymore.
It's fundamental.
It's the critical competitive edge. And it's built on a foundation of reliable data and smart automation. Doesn't matter if you're managing a multi-billion-dollar FPSO project or optimizing a single back-office process like division orders, the demand is for precision, efficiency, and reliability. That's what determines if those big bets ultimately pay off.
Which leaves us with a final thought for you, our listeners. We've seen this clear dual need: investment in cutting-edge tech machine learning, advanced ERPs, electrification right alongside this persistent, absolutely critical need for specialized, almost traditional knowledge. Things like division order analysis, lease and title expertise.
Two very different skill sets.
Exactly. So what does that combination tell you about the skills needed for the future energy professional? Is the most valuable person going to be that hybrid expert? Someone who really understands the nuances of regulatory compliance and can leverage advanced data integration tools. It certainly suggests continuous learning will be key to navigating both the technical shifts and the enduring complexities of the business. Something to think about.